Credit on retention money, again, I would tend to think that normally what happens in the construction scenario is that when the money is retained, then it's more in the nature of a security deposit. It is retained by the main contractor more in the case of security deposit. And typically the builders also in their accounting books, they don't put it as sundry creditors. They recognize that under the deposits and advances. So from the sundry creditors account, where it's a liability to pay, it gets transferred to your deposits account, which is a different category of account. Therefore, this retention money can be considered as paid, deemed to have been paid, if it is agreed between the parties in that manner. And maybe in situations you can also arrange it in a manner that you physically pay the 10 and take it back as deposit if you really want to. There could be cases where you pay it and take it back also. So the nature of the transaction is not going to differ whether you pay and take it back if it's a reciprocal transaction or you retain it, agreeing between the parties that to that extent it's consideration deemed to be paid but retained by me for some future maintenance, etc. So therefore, the credit may not be an issue according to me. You can still take the credit on the basis that the money has been entirely paid. This 15% deficiency, the other issue which can arise is that this 15% is it on account of goods or material. Rowan, the illustration also have stated that 15% is for some issue in the service. But if assuming that 10% of it is relating to material and 5% of it is relating to service, so can we attribute it into 10 and 5 because the entire 15 cannot be attributable to the service component. Therefore, accordingly, you have to determine the tax. So if it is nothing is coming out clearly, then maybe we should pay it entirely and treat it as entirely relating to the service activity only, and therefore paying on 85% is the right thing.
No, you are 85% or 100%. Conclusion is that on 31st March
you should
be on the 100%.
On 31st May the liability arises, you pay on 100. But what will happen is subsequently, since there is an issue in service, then you can claim any credit.
638. So I think the speaker just clarify.
So you initially since the
first pay.
Yeah. So first pay tax on 100 when the point of taxation arose, and subsequently since the certified amount is revised to 85, then on that 15 you claim a credit under Rule 60 of the service. Question 9.
Since you are just attention, excuse me. Sprinter groups, I think since you have attributed that 31st March being 31st May being POT as event obligating payment, and you attributed the reason to my analysis, I want to say no. Because in my view, generally in such contracts, the event obligating payment is only after the certification. So once the amount gets certified to 85%, then only the event obligating payment and is a continuous supply. This is number one. Number two, there is only one problem. Under the earlier continuous supply rules, the event obligating payment was important. But now what has happened, if you have issued an invoice before the event obligating payment, then the POT becomes the invoice date. Because there are 3 dates. First is invoice date or the payment date. That's first thing. If invoice is not issued, then only you have to go to the completion date. And what is completion of continuous supply? Event obligating payment. Earlier it was not like that. For continuous supply, it was event obligating payment or money receipt. Now what has happened is, because you have issued the invoice, and what is when you have issued the invoice? 1st July. Assuming that running account bill is an invoice. Because the word account is creating a bit of an issue. Whether it is a statement or an invoice. So it could also consider as a statement. But one would say that 1st July is the date when the bill is being issued. And I think that, according to me, in this context, would be the period, and not 31st May 2014. Because 31st March 2014, that is not an event obligating payment. The fellow will pay only if the bill is certified at 85%. Then the certified bill, then only I will pay you.
So I would think that, I mean, as far as my experience goes, the contracts have some milestones for billing, and once the milestones are achieved, then
Milestone?
the event obligating payment arises.
So you are saying 31st May was a milestone. But please also understand, event obligating payment, the fellow will pay, the contract also provide only on certification. So that certification becomes the event obligating. We may agree to disagree, but this is my view. I thought when I differ with you,
Sure.
I should certainly point out. Excuse me. Because all is offensive. So the first is 1st July is the POT if my view is taken. But there is one more view. On the 85%, according to me, running account bill, the word account bill, one may say it's a statement. Really speaking, the real invoice gets issued only on certification. And that is the issuance of an invoice. So that is the event obligating payment which matches with the issue of invoice. And you can say that the POT is on that date. That is number one. So you need to pay service tax only on 85%. Then on the 85%, again they are going to pay you only 90% of the year and not 10%. So there also I think we can say the right to receive money is only 90. There also you can have two invoices, part A, part B. A is an invoice which is the complexity, you have this thing on the 10, it will not be an invoice at all, it is only an account. This is my view, we can agree to disagree. Shall we go to the next one?
Yeah.
Sir, you want to review my view, your speech?
No, that-
You feel I am wrong, or you want to give you will have always the last word.
both of us continue to have different views.
Yes.
Also. It's not a question 9.
On the lighter way, he said both of us can continue to have different view. That is continuous supply.
So on question 9, the primary issue is whether there is a service, because there are two companies who have agreed under an arrangement whereby each of them will have some infrastructure, etc., but nobody will charge each other. Ultimately, they will charge only their ultimate customers from whom to whom they provide this. So whether at all there is a service between the two companies is the first issue which may arise. So I would think that there is a service arrangement between the two companies. If there is a service, whether there is a consideration for the service. Because if you see the definition of consideration, it says consideration includes any amount that is payable. And there is an agreement between the companies that there is no requirement to pay each other for this. So can there at all be a consideration for the service, because there is nothing which is payable? Though the definition says is inclusive, and somebody can say that inclusive definition is only, you can interpret it to include non-monetary, etc. But ultimately there is something which should be payable. And when there is no agreement to pay or nothing is payable between the two parties, then there cannot be any consideration. Therefore, you can say that there is no consideration, even assuming there is a service. It's only a free service between the companies, and therefore there cannot be any liability to pay tax. And the authorities will try to invoke the rule saying that consideration is not ascertainable. And they will say that if it is not ascertainable, then I will get into the valuation rule. And if you go into the valuation rule, it says that you should ascertain the consideration of a similar service. And again, there will never be a case where they will be able to ascertain the consideration of a similar service which they provide, because all the services, similar services which they provide, there will not be any consideration at all. So they can't invoke that rule and go to the similar service. Then the next rule which can apply to them is only this cost. And if you see that rule, it says that the service provider should determine the cost. And there the authority does not have the power to determine what is the cost. And that can be determined only with the service provider. And for the service provider, again, how will it determine what is the cost of providing the service? That again becomes an issue. Therefore, in this scenario, there cannot be a ascertainment of consideration in my view. And there is a decision in the case of income tax law where BC Srinivasa Shetty, where one of the quotations they held that if the consideration is not ascertainable and if you are not able to implement the law, the machinery provision, if it fails, then the charging provision will also fail. So going by those large principles, we can try and say that there should not be any service tax, even assuming that there is a service under consideration of this activity. In fact, this was raised by the DGCA investigation in one of our client cases, so we argued in this manner and then they haven't come back. It happened about 5-6 years back. After that, they haven't come back, so we are assuming that they have agreed to argue. So the question is also whether they can invoke 8A. So 8A can be invoked where the point of taxation cannot be determined as per the rules. As the date of invoice or the date of payment or both are not available, then the excise authority can invoke rule 8A. So in this case, there is no invoice issued and there is no payment also. So whether at all they can invoke 8A is a question arises because it will arise only in cases where there is a possibility of issuing invoice or where there is an event of payment or invoice which can arise at all. And if it cannot arise in any manner, then invoking rule 8A is not possible from the department point of view. So these are the broad aspects of rule 9. On rule 10, question 9, question 10. So completion of service is in March 2010. Therefore, TOTR itself will not apply for this. That is the broad view which came about. But when you receive this amount, it will be taxable. When the amount is received, it will become taxable. So TOTR does not apply. And whatever excess amount is received, it is partaking the character of money which is refundable. It is not relating to any service activity which is performed, and therefore it will not be liable to tax. You cannot treat it as an advance because even if it is an advance, it has to be for providing a service. And therefore, since there is no contractual arrangement to provide a service, this money will still be an amount payable, and there is no liability to pay service tax.
Just for the removal of doubts, this is not fully on service tax, but since he has used my initial, I need to clarify one or two things. I am neither ARK LLP nor ARK Associates, I am ARK Company, so it is not for me. But there seems to be some deliberate design in using my initial. First of all, I never get money, we forget our excess money. I am not BMR. Second, most important, he says 750 rupees I get excess, I keep. I am the last person to keep any excess money. I will write a letter and return the money. This has happened last week in our office, that somebody pays excess and we return the money immediately. So, Mr. Shivraj, on a lighter way, you are casting aspersions that if anybody pays me excess, I don't return. No, I will for sure pay. But that such mistakes do happen, we immediately return. Some people pay without TDS, we also say, here's the please deduct the TDS. This is for the removal of doubt. Explanation. Explanation come for the removal of doubt, which is applicable from retrospective effect. And the last is I find my returns perfectly. You said I am not returned. Service I return, I am not returned, but I am perfect. Sir, have I clarified?
The doubt is already removed that it's not intended to refer to you, though the initials may